This is Abhilasha from Blue Sky Analytics talking to Chandru. And very quick introduction, Chandru, in one word, and then we will dive straight into one sentence, sorry, and then we'll dive straight into the alphabet soup of climate acronyms, which is so complex that even I don't understand. And I don't understand like how we are going through like climate action and climate risk with all these acronyms like TCFD and NGFS. So we'll try to decode that for our audience today. Yeah.
Okay, great. Thank you, Abhilasha. Nice speaking about the alphabet soup. As you requested, maybe in one or two sentences, I'll do a quick intro. So I'm someone, who's had experience in, climate change, sustainability, strategy, driving businesses, heading businesses, and, experiences in investments, banking, risk management, and various other fields over the past 35 years. And I'm here now as an advisor to Blue Sky.
Awesome. Thanks so much. So the first alphabet soup that I want to go for, the first acronym, very famous, I have heard about it many times. It's TCFD, which is Task Force for Climate Related Financial Disclosure. But what is it and what does it do and what's the point of TCFD?
Yeah, great question. So TCFD was actually, as you rightly said, so it is a task force and it is recommended a framework for businesses to actually report on the risks which they face due to climate change. So, and it's not just actually about disclosures, it is also about, how is their governance structure, what is the strategy which they have. So it's basically bringing into, integrating climate change into business strategy, I would say. And it has many, aspects to it. But one of the important aspects is on actually understanding for a business and, what are the kind of risks because of climate change and what are the opportunities because of climate change. And this is split into two. One is called as the transition risk and another is called as the physical risk. Both are important. Transition risk is basically to say that, okay, when an industry, most industries are facing transitions. So whether they be actually in edible oil manufacturing, whether they be in banking, whether they be in automobile. And the most telling transition I can say is currently is automobiles, which is transitioning from ICE vehicles, internal combustion engines, to electrical vehicles. So there is a lot of transition which is happening, and this is being driven by various factors. So for an industry, they need to understand whether it is market, reputation, strategy, what kind of things are actually driving this transition, and they need to take steps accordingly. Physical risk is a very, very important element of TCFD, and this involves actually things like flood risks, heat stress, wildfires, and so on. So there are actually around 8 to 10 physical risks which have been actually mentioned by the TCFD. And organizations have to understand the impacts on the balance sheets or on their investment books in dollar value, if as much as possible, of the impact of physical risks.
And I have a quick question. How do the companies measure the climate risk right now? Like, at the moment, like, are they using, does TCFD provide data? And also like some part, like how old is TCFD exactly?
TCFD is quite recent. I think this came about in probably 2019-20, in that period. This was headed by Michael Bloomberg, who was the chair. And currently, there are certain ways in which you can actually measure the impact. But, largely, it is not very prescriptive. Companies can actually, take their own path in actually understanding. But whenever you want to actually understand the impact, you will require basically a kind of a formula or a framework, into which you'll have to feed in your assets on one side and the data on climate risk on the other side. So how it works is basically you're trying to understand how climate risk is going to affect either my physical infrastructure or maybe my supply chain, my manufacturing process, all this kind of things. So you need to feed in, where your physical infrastructure is. And then, you'll have to actually also understand, bring in and say that, okay, what happens if the temperature moves up
Yeah.
by 1.5 degrees or 2 degrees or 3 degrees and so on. Basically, what you're trying to understand is if the earth warms up
Yeah.
by so much, degrees, what is going to be the impact in the near future and in the medium term and in the long term to my actually physical assets, and what are the actions I need to take based on that.
Do you think like companies, banks, various asset managers are currently calculating their, physical risk or transition risk or climate risk per TCFD framework, or they're just starting, the process is just starting? Like, where in this progression we are at?
Yeah, I think, see, all across the world, people have been setting up, because TCFD itself is new, the prescriptions are new.
Yeah.
So I've not come across anybody, talking as of now, the dollar value impact to their portfolio because of all these things.
Yeah.
So it's not going to be easy, but I know that, a lot of funds and corporates have actually started this endeavor.
Yeah.
But this is the first time, probably, they will be, I mean, maybe I've seen some reports, but they are not numerical. They're
Yeah.
still talking about strategy and everything. I've not seen any report which is numerical and saying that this is the dollar value, but that is the aspiration, I would say, of actually corporates or funds and banks. Yeah.
Yeah. And
But it also depends, Abhilasha, on the availability of data.
yeah.
That's very important, because the availability of data for today,
Yeah.
and if you're getting into predictive scenarios, you need to actually also get data which can actually move along that path.
This is like
So that is
brand new. That means like it's like just couple of years old, and like that understanding of climate change and climate risk for a business, for economy, for the balance sheet of a bank, for the portfolio valuation. It's like just a couple of years old, this whole concept, and hence like I think it's going to the market, and the whole process will unreveal itself in like 2-3 years now. Yeah.
absolutely, absolutely, yeah.
I have another sort of alphabet acronym, which is much more popular, and I think it's older, and it's been around for some time, and it's ESG, which is environmental social governance. And so would just love to hear some of your thoughts on what ESG is. What's the point of it? Do we really see an impact from ESG, or has it just become an acronym?
I was with MSCI before, heading MSCI in India, the MSCI India business. And MSCI has been a thought leader in actually introducing and building up the ESG momentum. And we have seen actually, there is significant impact, and this can be easily seen when companies which are doing better on ESG, they get actually sought after more by large shareholders, and increasingly by retail shareholders also. So
Hmm.
what you see is that clear gap, and this gap has been widening between actually the companies which have not been actually focusing on ESG, and the companies which have been focusing on ESG. And conversely, if there are governance issues, if there are social issues, if there are environmental issues, you see the impact on share prices being much harder nowadays.
Yeah.
So that impact is also increasing. So to put it in a short, this one, so ESG is quite important for institutional investors, and we have been seeing the positive and the negative impacts for quite a long time. And I would say that it has been quite pronounced out of the after the 2008 great financial crisis,
Yeah.
when the statement which was quite often quoted in financial markets, that greed is good, that went completely out of the window. And the governance structures got more tightened, and hence people realize the value of good governance.
Yeah.
So that is one thing which has been there. And of course, all the COP meets and everything, and also the incidents, the volatility and the intensity and the frequency of the climate related incidents, the losses and everything, and especially like the wildfires in California, in Australia, and now increasingly in Siberia, and even in India also, we have seen actually quite a lot of wildfires
Yeah.
happening. So these kind of incidents, and also things like, Indonesia shifting its capital away, to actually Borneo forest because the capital is sinking.
Yeah.
Jakarta is sinking. And also, Maldives, if the whole country is now searching for land because they think that in another 20, 30 years, they will not have a country. So that is the effect of seawater level rise. So
Yeah.
all these things, bring into the focus the effects of climate change. So that is where, ESG actually plays an important part. But apart from that, there are a lot of litigations have been actually happening. Companies have been facing litigations and everything because of the environmental compliance not being maintained, because they're polluting rivers and polluting the air. And we have had a lot of incidents of this kind of an activism which is happening. And
Yeah.
even in, in India, the National Green Tribunal has been very active
Yeah.
and passing orders of shutting down plants, which are not complying or which are polluting their
Yeah.
environment and everything. So the
But
water bodies, many of these things, yeah.
But do you see investors getting actively like involved in this compliance or in this data or in this monitoring? Because at a planetary level, like net, we still produce about 50 billion tons of carbon, and we are at 419 ppm. And unless we first take like, we're talking about like net zero and carbon sequestration and all the projects to sequester carbon, but unless that 55 billion tons goes down to something like 10, 20, preferably zero, like unless you close the tap, you can't stop your like house from flooding, like, and the tap is not just like open, it's like getting wider and bigger every other day. So if I look at like energy industry, which is about 70% of emissions, which is your transportation, coal power plants or plants and so on, do you see that this will be reduced with ESG, or what is going to happen is that stocks which don't have this emissions component, they will get high valuation, but the industries which do have this emission component, they just sort of float as like relatively cheaper stocks in the market, which is what we're seeing because every other ESG fund is very heavy on tech. So it contains Amazon and Google and like everything. But like our economies and our societies are still like sort of, on coal and oil and carbon.
Yeah, yeah. No, very good question. So the point is that, most ESG funds have been shunning the so-called polluting, highly polluting industries and everything.
Mhm.
So that is one way of actually pushing. And we are seeing, and it is quite visible that these companies, who are being shunned, so they feel the pain that they are being shunned because of actually, being highly polluting and everything. So
Yeah.
what they've been doing is actually, they've been actually putting in place, various measures from, say, companies like ExxonMobil to actually across the spectrum,
Yeah.
like in India, HPCL, BPCL. Though there've been a lot of transformation which is happening. Even take a company like Reliance Industries, which was completely, which has been, even now it has a lot of exposure to hydrocarbons, but
Yeah.
it has been actually pivoting rapidly into renewable energy, green hydrogen, and so many other things, and very, very rapidly.
Yeah.
Why forget even, corporates, look at countries. Countries have started realizing that this is the end of actually, the end is coming as far as fossil fuel is concerned, even though right now, the crude oil prices have been actually moving through the roof and everything. But I think the force of actually, people wanting to move away, this is, I think, is a temporary phenomenon now, which is happening because of these shortages. And, over a period of time, and these things do take a lot of time, but, the next 10, 20 years, we can see, almost, this thing which you're saying, the 50 billion tons,
Yeah.
substantially reducing. And also, I have a hope, Abhilasha, because there is a lot of technological innovations going on. And this is what is a transition which I'm talking, of the
Yeah.
TCFD, which we're talking about as to how countries are transitioning. Saudi Arabia is transitioning. You can see how the world's largest oil producer have been actually
Transitioning.
transitioning.
Yeah.
So there is a lot of innovation actually happening. And, at the end of the day, I think, the COP meets have also been actually focusing and, bringing into fore the, importance of actually moving away from, fossil-based fuels.
Got it. So there is another term which is sort of quite in the sector. It's called NGFS, which is Network for Greening the Financial System, and it's a system of banks. So it's sort of like heading ahead of ESG. Like ESG is for investors to look at like certain criteria. to make investments. But in this, like banks and central banks are, which is like, are the backbone of our economy, is sort of coming together and trying. And I think they got together in 2017 and established NGFS, and they're trying to figure out how to move towards a more low carbon economy. So yeah, some of your points on NGFS.
Yeah, see, I think, NGFS has been established basically again, so banks, credit portfolios. So banks are lending to corporates who are now exposed to climate risks. So how do you actually account for these climate risks in your lending book is important. So, for example, say a bank is actually lending to a resort, which is there at the near to the sea.
Mm-hmm.
So the risk which it actually faces is quite high. Or forget about the sea, even within cities, if there is a flood risk, then, things actually then start going haywire. It could be because of wildfire, it could be because of, many of the other things, which is actually happening, because water stress also actually, leads to a lot of problems. Now, for anybody who's having an exposure to, to all kind of industries, but what is required is for them to account for this climate risk. And, in the pre-lending stage, if they understand what is the risk, then the bank generally prices these loans in an appropriate manner. That's what ideally they need to do, is to price these loans to account for this risk. So far, banks have not been directly understanding and accounting for this risk. So the endeavor and the attempt of NGFS is to actually, move banks to actually start understanding that there is a risk because of climate change, and also start actually accounting for it either in the pre-lending stage, where you can price that risk, or in the post-lending stage, where you can still price that risk, but it's not easy.
Yeah.
You will have to provide for capital to actually, say that, in case if there is a problem like this, then I have a capital this much to actually buffer it. So that is the principle behind NGFS.
This is effectively to make the economies more resilient to climate change, that tomorrow, you don't have a domino effect like the subprime mortgage crisis in 2008, that because of a wildfire or flood, certain banks like portfolios take like a serious hit, because it's a very fundamentally systemic risk. So if you're not protected against it, and if you're not measured it properly, then you do have, if we, let's say, take some bank which has a real estate exposure in California, and wildfires affect significantly high number of like real estate, houses, commercial, the bank could find itself in a pretty tricky position. And if it kind of like multiples, like, the way it happened in 2008, if that happens in 2028, we could be looking at a much bigger financial crisis than we saw in 2008. Yeah,
absolutely. I think, there's also this thing when you're talking about transition risk, even the wars also actually come in. There is actually a very good data and studies which actually, say that climate crisis is at the core of many of the wars which are taking place. And I was just actually reading about one of the Russian or the Ukrainian climate scientists saying that the basis for this war also is actually, a lot to do with climate crisis. So Ukraine is a breadbasket. So, and it has got so many minerals and commodities and everything. So as population grow, sorry,
and warm ports.
Absolutely. So many of these things are coming from there.
In fact, what we saw with like Syria in many ways was effect of economy and people who were very strained by drought for a really long time, converting it into a political unrest, which got
absolutely
civil war situation. So just want to close this up really quickly. We've covered three things, which is NGFS, TCFD, and ESG. And they're all sort of aimed at either making proactively environmental investments, thereby to produce a low carbon economy, or to price the risks of different assets in a way to account for climate risk, both physical and both transition, so that, again, with a, it's like a carrot and a stick approach of the financial system to sort of incentivize more and more, environmentally friendly and sustainable like endeavors, and to penalize or to price higher more climate risky or endeavors. One thing that I kind of want to come back to as a person running a data company is that currently, is there a data structure? Like, how do there are all these goals that NGFS has, that they want to price like flood risk and drought risk and all the different kinds of like assets and portfolios, but is there a data data product, like how do they have technological capacity? Do they have data? Like, are the banks in the world today in a position to actually price that risk, or is there going to be a little time lag and development and technological innovation in that space, that we will see over the next few years?
Again, see, the ultimate is the quantification of this risk. Okay, but before that, it's not a very simple way of actually. I would say the process is not simple because first of all, you need actually modeling to be done, and within that model, as I explained, before, you need to get your assets inside, and then you need to get your climate data inside that model, and then the model actually starts working, and then gives you all the data and everything. Now, before actually, the first thing is for them to arrive at the model. There are actually the models like, arriving at doing a kind of a climate value at risk models and everything, which are actually coming into the fore. But then, you need to, then there is a technology piece which needs to be done. And then the data piece which needs to come. So only then, quantification of this risk will actually come into fore.
Because we stand, like, for instance, very simple environmental things, right? Like air quality, water quality, data on carbon emissions. Even that doesn't exist like in the way that you would want at a asset level, portfolio level. So if you want to, let's say, do climate risk data, which is like incorporating historical, real time, doing a few simulations or models on 1.5 degree, 2 degree warming, and trying to assess a situation for 2025, I think there is a lot of, like, there's a massive data gap that at least I see. Like, I don't know if there are other competitors out in the market who are providing really high quality data to NGFS like members or to companies following TCFD frameworks, or is it like that because the frameworks are still getting developed? I don't know how much these coalitions or these groups have thought about the necessity of or the missing gap of data in this whole equation.
Oh, I think there is a huge data gap, which I can easily tell you that there is a huge data gap, because the people, in fact, many people don't even know that there are actually data providers like Blue Sky who exist, who can actually provide them quality data and everything. So maybe there are some other entities who can actually provide, but comprehensively, there is probably, I've not come across any data company who can provide very accurate, comprehensive, historical and future data for simulation and everything.
Yeah,
there is nobody actually so far.
And all the banks in the world, like all the central banks, all the individual banks, and if tomorrow they have to start to assess their climate risk, it's a massive undertaking. I don't think like even just Blue Sky can like help or assist all the banks, like, are they, because each of the data set, like, I'm not completely aware of, I'm more on the climate and data side of things. I don't know who are the people writing on the banking and risk side of things. But if, let's say, different portfolios have to calculate their, climate risk and quantify it, we are looking at 30 to 40 complex environmental and climate parameters that somebody will have to measure, monitor.
Absolutely.
Because all of it is very linked. So in this, like, Arctic melt will come in, wildfires will come in, temperatures in different parts of the world will come in, the way the sea currents are transitioning will come in, and it's going to be a pretty extensively hefty exercise.
No, not only that. See, this is only the first problem which you're trying to solve. The second thing is the correlations between all these variables, because that will be the next one. And arriving at correlations also requires. The other thing is a geographical coverage. So how is there anybody who can provide, geographical coverage for all kind of, climate risk data? No, absolutely no. So that is one thing. And even if you actually get that, then the next level is about actually arriving at correlations and everything. But what I think is happening is there is a two-way dialogue which is happening now. So between people who are actually setting up those systems, data companies like you, modeling companies like, maybe MSCI, and, a few other providers who can actually come in. And then, then there'll be the technology interface and everything of actually taking your data through APIs and everything. And they bring in their actually portfolio data into that. And then, there'll be a lot of testing and everything which happens and everything. So there is I see that, sky is the limit.
But for massive undertaking. I forget about like business and everything. Like sometimes when I think of like all the clients that are going to unveil over the years, from companies to banks being like because they all have loan portfolios, real estate, commercial, and because what we're talking about is, unless we do start doing this exercise in different banks, starting from smaller banks, culminating at like national levels, international levels, and we don't start doing this exercise in our books right now, we would look at a much more wider domino effect than 2008, because
Absolutely.
the rate at which extreme climatic events are happening is accelerating. So it's not just going to happen for like one small county in your country, one state, one district. It's going to be lots and lots of places, and if the exposure is not accounted for, we can see our global economy, the miscalculations that happened in subprime mortgage. It was very small, very few BPS, right? It was like they expected some less number of people to not repay their loans, and more people repaid and did not repay their loan. That was the sort of starting and accelerating point of the 2008 financial crisis. In this case, we will be looking at the calculation that banks and insurances didn't expect, or the economy and society at whole didn't expect, that many houses to be burned in a wildfire, or that many real estate complexes to get flooded, or this much like sort of factories being affected by droughts. And that happens, and we will, one of my professors, like Gary Gorton, he was a consultant with AIG during 2008. He always used to say, like, I was studying environment and I was taking a lot of classes here and in the environment school, and he was like, Abhilash, I can tell you, like he used to call me Abby, Abby, I can tell you, global economy will fail way before planetary environment fails. Like the environment will be able to sustain human civilization for much longer than global economy will go through a domino effect, like the
Yeah.
subprime mortgage crisis, because we haven't accounted for, like, we haven't built our system that resilient. And I think a lot of, like, including climate data in every single financial decision is about making our financial system resilient, so that what will happen will happen. We've already produced like hundreds of billions of tons of carbon emission. We have already crossed 418 ppm of CO2 concentration, which hasn't happened in 800,000 years of planetary history. No other human being, none of our ancestors have lived with this warm, this much greenhouse gases in the atmosphere. So I think climate change will come, but we have to, it's not even just about like mitigation and adaptation, but also making our systems more resilient. So on that note, I think three acronyms took quite a lot of our time, and then we would like to probably do this again and pick up some new acronyms. I know of SBTI, which is science-based targets initiatives. Chime in a few that you think would be key, and I'll study a little bit about them, and then we'll catch up next time.